Hello, I'm Robert and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. If you've been following my series lately, I've been discussing the differences between backtesting and forward testing with my floating grid technique. Today I want to actually demonstrate this difference with a market range from January of 2024 to the current date, where I have done testing with both the live market data based upon bid-ask pricing, and I did a full back test using OHLCV data, that is open, high, low, close, and volume. The interesting part of this is just how different the results are, and yet how similar. It shows and makes the case for what I have always taught on this channel, that you should not rely on backtesting as a sole means to go into a live market. So let's get into the charts on the screen and talk about the market itself that I used for this test. I used the Euro USD French vanilla account. This has roughly a starting balance of $5,500 to $6,000. I kept it consistent in both cases for the live market and back test, making sure that everything stayed identical for the starting point. What we are looking at on the screen is the actual daily amount of trading that went on. And we can clearly see the areas where volatility really spiked up, and just how volatile the market became over the basic average. So we get an idea of just how volatility affects the grid trading system, particularly when I am using a take profit and deviation of 2 pips. This is incredibly small, but deliberate to give me a worst case scenario for this test, to actually see just how bad things can go wrong, or how good if I'm lucky. The goal of this was to use a deviation or a grid spacing of 2 pips, a take profit of 2 pips, and an average spread of 2 pips. That is complete uniformity across the bid-ask spread process. And then to translate that into the OHLCV data set for the process to continue. So we see clearly how our trades actually look. And we can zoom into any given section and actually look at the buys, the sells, and the stop losses. But we'll get into some of those numbers later on. Let's move to the actual trades themselves. And this is a bit of a big chart. Now that our trade history chart has fully loaded, here are all of the trades that took place for the live test. I'm displaying this graphically because I want to be able to demonstrate the significance of the amount of trading that this bot did, both in backtesting and in forward testing. And we can see the stop losses in red, which happened over here, and clearly the teal light blue reductions that took place throughout the entirety of the whole trading system. And of course the green are all of the take profits. And you can see the basic scope and scale of market price action through the way this chart is laid out. It's an interesting way to look at several thousand trades. But now let's take a look at the real point, the point that matters the most. How much equity did this account gain or lose? And it will load, and we can see that it gained a lot. Now, some important points about this. The zero line is the starting balance. Anything below the zero line is cutting into the initial profit. And we can see that we did actually do that in the beginning with stop losses. But throughout the rest of the trading, we can see clearly an uphill profit. And if we zoom in, as I have demonstrated in other videos, you will see the barbing of the reductions over the course of the trades themselves. So you have a clear and concise live market approach that guarantees a very specific blueprint or marker that we can actually test our back test against. So let's get into the spreadsheet and really look at the numbers. Now that we are in our spreadsheet, we are going to go through and actually look at the differences between a live trading market data set and a historic market data set. For the purposes of this case, we processed 2,685,000 candles for both live and historic. The range from January of 2024 until today. As mentioned, dealing with 250 levels for the grid with the take profit, deviation, and spread all at 2 pips to keep a consistency within both bots to give an apples to apples comparison. Let's start with the charts, the live market data. The total for the live market was $506. The total reductions was roughly around $137, and I took a total of 41 stop losses from live market data. The grid bot initiated and conducted 9,218 trades. And now we get into the averages per trade, which was roughly 5 cents. The average reduction was roughly 0.014 cents. The average number of trades per month was roughly 768, and my average profit per month is roughly $42. My average reduction per month is $11 for the live market data. For the historical market data, my total profits were $271 roughly. My total reductions were $158 roughly. No stop losses recorded in the back test. I took 8,976 trades, roughly a difference of 300 trades. My average per trade was only 3 cents. My average reduction was 0.017 cents. I took 748 trades, only 20 trades different from the live market. My average profits per month were $22, roughly almost half of the live market data set. And yet my average reduction was higher than the live market at $13 per month. Now I ran this simulation several times to make sure that the data set was accurate and cross-tested everything. The big question comes in terms of why is there such a drastic difference, especially between the live market profits and the historic market profits. This is almost double. And we can see that all the way through, even with the average profits per month, that we are almost double. A lot of that has to do with the very simple reality of live market data. For the live market data, I used the bid-ask pricing. For the historic market data, it's constrained to the open, high, low, close positions. Let's take a look at that in terms of what that really means. A live market data has an upper, a lower boundary, and price can be anywhere in this area. So no matter where that is, the price can hit and trigger. But on a historical data set, you only have 4 data points. You have your open, your high, your low, and then your close. So you can only have one of those 4 situations occur. And this really is a problem in the context of all historic data that uses OHLCV data sets. Trying to record bid-ask pricing from a live data can be quite difficult and expensive, which is why most backtesting uses the OHLCV set. It's convenient, it's easy, and you can get 20 or more years of this data set at a reasonably low or even free, depending upon your broker. This is really the biggest difference between the backtest and the forward test. The difference between live market data and historical data. It's interesting how 41 stop losses took place on a live market, but not on the historical. This type of a framework, this type of a system, demonstrates clearly why you need to be careful with backtested data and why you need to be sure to go through and don't go direct to a live market just on your backtests. Okay, I've just quickly added a difference between a live market and historical market so we can see an accurate comparison. The difference is the live market showed a higher profit of $235 more than the historical data. The live market was $21 less in reduction, meaning that it took more profit than the historical market just on the basis of a reduced reduction amount. Of course, the difference of 41 stop losses from the live market. And the difference between the live and historic being 242 completed trades. The live market clearly took more trades. Opportunities with bid-ask pricing were significantly greater than that of strictly the historic OHLCV data set. Average price per month was roughly 0.024 cents. The average reduction was actually less in a live market, and the average number of trades per month was 20 more per month versus the historical market. The average profit per month, the live market made on average $19.64 more each month than the backtesting demonstrates. And the average reductions per month, the live market took $1.76 less every month for an average reduction rate. That meant that the live market clearly was more profitable than the historic market. So what do we get out of this 2 million candle data set? Very simple. Historic markets are good for testing the theory. They're not good for seeing real world performance. Live markets or forward testing must always be used before you deploy. That is critically important, and if you don't, you're going to find yourself not understanding the differences in your results. You need to be acutely aware of the difference and the constraints that backtesting puts on your data set versus being able to pull live market data in real time. The strategy works perfect. The floating grid has been proven to be incredible. But the fact that the differences in total profits is so drastic is a bit of a disappointment between backtesting and forward testing. I would have hoped that these numbers would be more within a statistical average of errors, but that's not the case here. The other thing that is concerning about backtesting is the fact that the backtest did not take any stop losses, but clearly the live market did. And of course, 242 trades is quite significant. Now, in terms of my own personal trading, as I've talked about in previous videos, the backtest has helped me really see important numbers. That I have in fact modified some of my own trading parameters. But it's clear that the live test is critically more important than the back test in terms of what you can expect from a live market variation. You need to really focus on live testing. Take the time. It's taken me a year of data to get where I'm at right now with just this one single live test. When you're dealing with your trading, you can't rush. You can't go out of your way to try to get a situation that's going to cause rapid losses by trying to get into the market thinking you're going to miss out of an opportunity. There is no such thing of missed opportunities. Opportunities come every single market. It's just a matter of finding them and being ready for them through a thoroughly tested and calculated strategy. I hope this helps deal with the questions that you would have about whether or not backtesting versus live trading is important. More importantly, with the floating grid technique, I hope it demonstrates how viable this strategy is as a passive mechanism. Even in the backtesting, it's important to understand that a passive approach of a profit of $271 is still very good. This is a very active approach that really sits and does nothing. It actively waits for the market. It doesn't calculate strategy. It simply purchases a position at 2 pips from its last position, and it maintains that distance over time. This is not bad for a process that really does no real mathematical or indicator-based calculations. Of course, the live market showing nearly double that is quite impressive. But always treat your back tests as a stepping stone in the direction of whether or not your theory is sustainable. If this came back negative, then when I did my live test, I would have to be aware of that, and I would have to tailor or maybe even tweak my algorithm in order to test it again. By doing both simultaneously and back to back, you can draw conclusions and inferences about the market and your strategy as a whole. Share your thoughts. Leave me a comment and let me know what you think of this test, the live market versus the historic. How does this help you with your trading? And how does it reflect in terms of the strategy itself in your mind? Would you use a floating grid strategy that basically makes 3 to 5 cents per trade if it had this kind of success rate? Let me know. I'd like to hear what you have to say. Please hit that subscribe button if you are not subscribed to my channel. And if you find this content useful and helpful, please hit that thumbs up button. It really does help spread the word and help me get my videos out to more people. Thank you for watching, and until next time.